Well, I think we're using something that was built in the 80s to offer credit to people now in 2025. It's archaic.
Hello and welcome to Settling Up with Go Cardless.
And I think financial education, we don't learn about interest rates and APRs at school. You suddenly get into the big world, you want a mortgage. Bring back the landline, I say, yeah. And 4-digit extensions where you can just, speak to someone, get something sorted like that. When I'm having a bad day at work, I just go on Trustpilot, I just look at our reviews. I go around kicking the tyres, making sure everything's working. Thousands of KPIs, we love a KPI.
Hello and welcome to Settling Up with Go Cardless, where we settle the score with leaders in payments, getting their honest opinions with hot takes and no chargebacks. Today, I'm joined by Hannah Matson, Chief Operating Officer at Creditspring. Welcome to the podcast, Hannah. Great to have you on.
Hello, thank you for having me.
Can you tell us a little bit more about yourself, your background and Creditspring?
Sure. So, as you said, I'm COO at Creditspring. I joined 3 years ago as VP of Operations and then moved into the role of Chief Operating Officer a year later. My background is quite varied. I've had various operational roles. I started actually in credit risk at Goldman Sachs, but that was much more on the sort of monitoring the internal credit rating scores on the trading desk. So very different to the credit work I'm doing now. Moving on into operational roles and venture capital, private banking, merchant banking, a little stint in hospitality. I ran a hospitality business for 5 years, which was a restaurant and a bakery, which was a very weird variation out of finance, but moved back into finance and then found myself at Creditspring working with the amazing team there on their mission.
Well, it's great to have you on the podcast. Thank you so much. Today, we're going to discuss the issue of the credit divide in the UK and how Creditspring's unique approach to lending is helping to solve that. So to kick things off, we're going to play approved, pending or declined. So it's our icebreaker and I'm going to give you some industry terms or concepts and you have to tell me if it's approved. So it's got the green light, you really like the idea or the concept and it's full steam ahead. Maybe you think it's pending. It's a good idea, it needs a bit more work, it's got the amber light at the moment. Or declined, terrible idea, stop it immediately.
I'll be honest.
Yes, please do. So the first one, bill or rental payment, including that reporting in credit scores, approved, pending or declined?
Definitely approved. I think to anything that opens up more data to whether you can access a loan or not can only be a good thing. At the moment, the credit score is mainly based on previous sort of lending history. And I think anything that can open it up beyond that is great.
And what about affordability checks beyond a credit score? So someone's got a credit score, you need to do some more checks to make sure they can afford to repay. Approved, pending or declined?
I think approved as well there. I think, again, you don't want to be lending to anyone that can't afford to pay you back. So whenever if people are struggling to pay us back any loans, we do I&E checks, income and expenditure checks anyway on that. So as much data is key here, right? So as any more data points that you can get to give people the most appropriate loans is best.
Finally then, financial education delivered by the government, approved, pending or declined?
Approved. I've approved everything, haven't I?
I'm
green on all of this. Financial education is key. It's so many are leaving school and just not really having a clue about taxes or interest rates or APR. It's just the jargon is just overwhelming. And I think that's leading to a lot of issues with, sort of inappropriate products being sold to people. So definitely approved.
Yeah, absolutely. Well, hopefully, the recent initiative by government we'll get to see it taught more in schools and we'll see the kind of long-term effects of that.
Let's hope.
And we're going to throw a couple of more personal ones your way so we can get to know you a little bit better. So what about getting to the airport as late as possible? Approved?
Declined.
Oh, okay,
declined,
fine.
Strong decline.
Straight in with that one.
I'm there, have a nice coffee, check in, everything ready to go. And I've got some nice time to think about what I'm about to do,
Yeah. And there's no risk of you missing the flight.
No.
I think I'm with you on that one. What about rewatching like a favourite film or TV series? Approved. That one, okay,
Yes.
Any particular favourites at the moment?
I Last of the Mohicans is my favourite film. So I'm like,
really?
I've seen that probably. That's probably the most watched film in our house,
Okay then.
Old school. Daniel Day-Lewis, legend,
Hitting the snooze button more than once. Approved, pending or declined?
Oh, probably decline. I'm a one-time snoozer, I think, and then I'm out. Otherwise, it just goes on forever.
Yeah. Okay. You don't want to drag it out for too long.
Yeah.
Oversleep. Yeah. Okay. And what if someone tries to call you instead of texting? Approved, pending.
Approved. I love
declined.
that.
Really?
Yeah, I would get very bored of texting. I'm definitely pick up the phone. That's one of the things I miss most about having a phone on your desk at work, is that actually everyone is now instant messaging at work rather than the days where you'd pick up and dial an extension and just get something sorted. I really miss that.
Yeah. It's interesting
so at work
that
at the same time. Yeah.
Yeah, we just don't have those like landlines essentially, where you would just pick up the phone to someone.
Exactly.
Yeah.
Exactly.
Okay. Well, bring back the landline.
Bring back the landline, I say, yeah. And 4-digit extensions where you can just, speak to someone, get something sorted like that. It's just so much easier.
Yeah. Okay. Well, thank you for playing approved, pending or declined.
Thank you.
Okay, so to start with, Hannah, then, can you tell me a little bit more about the credit divide? So this is the divide between those who can access sort of credit on fairer terms, right, and those who can't. So, yeah, what does that look like in the UK, and what's the compounding effect that it can have?
Sure. Well, I think a couple of stats first. Around 20% of adults consider themselves financially vulnerable. That means that they are probably going to come to some kind of harm at some point due to their financial circumstances. And around 40% don't have any savings. And I think when we did a survey, around 85% say that they do have unexpected unexpected expenses at some point. So if you add all that together, no savings, unexpected expenses, and financial vulnerability, we are underserving people by the credit industry because they don't have access to the credit they need. Due to archaic structure around that, whether that's the credit scoring, the APR, it's really difficult for some people to get access to credit based on the credit scoring. So that's where we're trying to come into play to try and narrow that gap and give near prime. So near prime being individuals who do have access to credit, but not your traditional credit and not very cheap credit. It's quite expensive. So we're trying to offer credit to them to try and narrow that divide so that the divide widens because people use the more expensive credit, they can't pay it back and end up getting worse credit scores and then paying more for credit. So it just widens that gap. So we're really trying with Creditspring to narrow it.
Mm-hmm. Yeah, so you're trying to break that kind of cycle, I suppose.
It's a terrible cycle. It's, you have your car breaks down and it's £300 and you can't get access to credit or traditional credit, so you can go to unregulated lenders. And then by the time you've paid back that loan over years, you could be, it can be double, triple that. So we're just trying to narrow that gap, and that divide.
And Creditspring, you have what you call a subscription-based lending model. So how does that work and how does it close that divide?
So we are trying to create a far more transparent approach to lending. So you pay at Creditspring, the way the product works is that you pay an annual subscription fee, basically. And we call our customers members because they are members. They pay us 12 subscription membership fees over a year. And for that amount, you get access to 2 loan advances and you pay one back before you get access to the second. And we are trying to make it far more transparent. It's fixed fee, and that's the key there. We do not capitalise on you struggling to pay us back. Mm-hmm. So up front that you are only going to pay that 12-month membership fee. If it takes you 3 years to pay us back on a payment plan, you're not paying any more than that 12-month membership fee. So up front, you can plan accordingly. You know what it's going to cost you. Obviously, your credit rating is going to be affected if you pay us back late or default, but we're not going to capitalise on that.
And so you mentioned there that you're offering these no interest loans, essentially. Yeah. Why are interest rates, and especially APRs, such a barrier when it comes to lending?
I think financial education, we don't learn about interest rates and APRs at school. You suddenly get into the big world, you want a mortgage or you want anything, and people just don't know about this, and financial education is key here. I think it's sort of research has shown that women, low socioeconomic groups, and the young really are lacking in that financial education. So they're going into these situations where they need a loan, but they don't understand the APR. They don't understand the jargon around it. So they're taking loans that are getting them into financially vulnerable situations. So part of our model, part of our product is that we actually have financial education as well. We have a learning academy as part of our product too. So you can go on our website, you can learn about it. But making that much more transparent, up front what you're paying. So there isn't as much education needed about APR and interest rates because you're not paying interest, you're paying a subscription fee like your Netflix fee or your Amazon subscription. So actually, exactly what you're paying. It's
interesting you mentioned that you provide financial education as well. I was going to ask you, where does the onus lie in terms of, who can provide that financial education? I mean, I know recently it's come up that the government want to make sure that schools teach financial education, but do you think it's a bit of both, a bit on the industry and on kind of school curriculums?
I think if you are offering, I mean, there's high levels of consumer duty now required, right, with the FCA and the FCA regulated, that we do need to make sure that we are offering the right product to people and they know what they're buying.
Yeah.
So it's no bonus to us to just misinform people about what we're selling them. We think transparency is absolutely key. So I think the onus should be on schools. I think we should be preparing people to go out. I think the onus is on the businesses to make sure that we are very clearly telling people what we are selling you. I think there's onus on everyone. Obviously, there's onus on the individual as well. But I think we need to assume that people that are vulnerable, who need money, we need to support them in their education.
And I guess it's also, as you say, that they're about cutting through that jargon, right? Because it's an industry that is heavily kind of jargon led.
Exactly. And it's the APR there is, if you ask someone to tell you what an APR calculation is, very few people are going to tell you that. It's a comparison tool that we legally have to stamp our product with so that people can see what they would pay compared to another lender. Mm-hmm. But it doesn't actually fit our model at all. The APR doesn't fit a fixed lending model because it's based on you holding that whole full loan amount for a full year, and you don't do that with us. So our APR actually looks very high on our product, but it's just we're trying to shoehorn our product into a compound interest-led product, and we are subscription and fixed fee, which is very different.
Mm-hmm. Building on that then a little bit more, how do you kind of manage charging for loans then? How does that kind of work in practice? What does it look like when someone becomes a member, if you like, of Creditspring?
So someone becomes a member and signs up and they agree to pay a subscription fee, or membership fee, I should say, and it's 12 months. They say our lowest one is £7 a month, and that gives you access to two £300 loans. And you pay £7 a month for 12 months, and you can borrow your first loan after 14 days. So we have a 14-day cooling off period, and that's not legally required, but actually our product is there for when you need it, for when emergencies happen, rather than we want to move away from that payday lending kind of label. So you don't want to just have a loan at the end of the month when you suddenly need it. So we do ask you pay for your first subscription, then you wait 14 days and you get your first loan. Mm-hmm. You can pay to bring that forward if you really want to, but most people don't. They actually want to wait because they just want that credit in their back pocket for when they need it, rather than a last minute desperate attempt to get some cash. So and then they pay their membership fee for 12 months, and then once they've paid off their first loan, they get access to the second. And actually a lot of people pay off both their loans in a shorter period than 12 months. So actually the APR is even lower because they pay it back. We have a settlement fee then, and then they can renew. And around 70% of our members do go on to renew. I
know that when we think about, especially in the UK, being able to access credit, it's typically relied on having a good credit score. And the strength of that credit score is key, right? But I guess if you were to ask most people, about their credit score, they probably wouldn't know what their credit score is, or even like what kind of information goes into making up that score. So I know that in the past it's been seen as something that's maybe a bit opaque. I mean, why is the credit score approach, in your view, becoming kind of outdated?
Well, I think we're using something that was built in the 80s to offer credit to people now in 2025. It's archaic. I think we're using credit history rather than payment history to decide whether we're lending to people. You've got some individuals who have never borrowed before, they've never needed to borrow, they've looked after their finances well, unable to access credit. When you have compared to another individual who's got questionable history with lending, who have a credit history there because they've been borrowing and they've been paying back. So I think, we've got access to so much more data now with open banking that I think it's just not a reliable way of deciding whether someone should borrow or not. People now have variable income sources. It's not just steady education. Lives have just changed. Things are just different now. So we're using old lifestyle choices to determine now whether people should borrow, which is just, out of date.
Yeah, I mean, I suppose an example of that is rental payments, right? Which haven't typically, that data hasn't kind of gone into kind of a credit score in the past, has it? That's kind of changing now, isn't it?
Exactly, definitely. And I think, we're using open banking now as part of our credit score. And I think we're seeing that, Netflix subscriptions and all these subscription payments are actually a really good indicator of repayment sort of success. So we are finding that we still use obviously the traditional credit scoring, but we do now use open banking, and we're one of the first lenders to do that. And we've actually got it automated. So we're really proud of that. We've been doing it for the last 2 years, and we're seeing that those that are approved through open banking have actually got, are behaving very well.
So yeah, I was going to ask actually, how open banking has kind of improved that approvals process from your side of
Massively,
things.
yeah. So anyone that is rejected through the traditional scorecard that we use, we then we offer them an opportunity to go through, and we obviously have to ask for permission to go through an open banking scorecard. Now, we are seeing that is an additional friction point on the journey. So we are seeing that we see about a 30% drop off there because some people just don't want open banking. Still got a weird, I think the name open banking, I've said this at Go-Kartless before, and we've had other conversations. It's like people are a little bit wary of it, like you're going around digging around in their bank account. But those that do want to use open banking we'll then put them through our open banking scorecard, and that really dramatically increases our approval rate. We want to be as inclusive as possible. We want to give all our potential members the best opportunity to get a loan with us, obviously while protecting the business and making sure that we're lending responsibly as well. But we are seeing it's incredibly successful, and so for the last 2 years we've been using an open banking scorecard that we've created, and it's helping our members because we're getting more people access to credit.
Yeah, that's really interesting actually to hear kind of how successful that's been. And I mean, obviously it's at the core of everything you do at Creditspring, but why is access to fairer credit so important?
Well, I think we were saying this terrible cycle that people go down. I think, 85% have unexpected expenses. And if you don't have that money there, you don't have savings there, you need access to credit. And also we're giving small loans. Not many out there are giving these small loans in the regulated space. So it's very important that we don't get people into these terrible debt cycles with compound credit, and the small loan you took to just fix something very basic, or be able to kind of throw a birthday party for your children because you don't have a couple of hundred. It's like you need access to credit for these things sometimes. So I think by enabling them to have transparent access to that with fixed fees, it's stopping this awful compound credit sort of roller coaster where people are just getting into debt cycles.
Mm-hmm. You must have seen that exacerbated somewhat by the higher cost of living at the moment, right?
No, we are seeing, we do our very best to support our members and make sure, we have payment solutions there for those who can't pay us on time. We have a huge team working on our forbearance and our vulnerable members to make sure that they can speak to us and we can give them support when it's needed. So we are seeing a little bit of that. But we actually, as a business, a lot of people think when you've had this cost of living crisis, that's a huge market for us, right? Let's go out. But actually, we really tighten our growth then. We don't want to be lending to people who can't pay us back because while they won't be getting into a debt spiral with us, we don't want them having their credit rating obviously affected by them not being able to pay us back. So we don't capitalise on the cost of living crisis by going, right, let's lend to everyone. We're very careful with our business model there.
I know that there's been numerous research over the years that shows that those who perhaps might fall into that financially excluded category, they're often slightly distrustful of financial services, aren't they? Or they feel like they've been stung in the past. Is that something that you find, or maybe through your financial education, you help people overcome that distrust?
Yeah, when I'm having a bad day at work, I just go on Trustpilot. I just look at our reviews because, all you see is it's clear, it's transparent. Like they're not trying to con us. Like what's the word I'm looking for? What's the trick here? Like what are we missing? And it is that transparent, that we want to make it much easier for people who are lacking in financial education to be able to find a solution. We don't litigate on people that are that don't pay us back. We very much we want to find a solution to people that are struggling. And obviously, 90% of our members pay us back on time. They go on to renew, but there are obviously those that do find themselves in situations, they lose their job, and we work with them to find a solution there. Some of them then, or we signpost them onto charities that can help them. But we very much want to sort of get away from this label of if you're lending, then you're bad people. We need the money that you're lending to us, but they're nervous about the repercussions of not paying us back. And we want to be as inclusive there as we can as well. And we have a team, as I said, who works with our forbearance requests that come in. We make them as tailored as we possibly can. We automate as much of it as we can so that actually they get quick solutions. But this is where I think AI can really help as well. We're using a little bit of AI in our customer support right now, but on the sort of forbearance side and the collection side, we're not. And I think there's lots we can do there to give people much faster solutions. At the moment, it's very much human-led, which we like, but I think looking ahead, I think AI can help us there for sure.
Okay, that's really interesting. I want to talk a bit about payments. So obviously running a subscription-based model, I'm sure that you need a really reliable recurring payments process. That must be vital for all of that to work. So what are some of the challenges when it comes to collecting loan repayments, and how are you managing those?
So the challenges we're finding are, the loan repayments, it is just offering as many solutions as possible so that they can, obviously we know some people have more than one bank account, but we just hold one on file. The direct debit, it is seamless with Go Cardless. They just work there in the background, and for, like I said, 90% is absolutely fine. And then I think we have the bank payments, the open banking with Go Cardless, basically. So when members are late, we give them an option to either pay by card or pay by open banking. And a lot are choosing open banking. And I think there's more we can do there as well. But direct debit, the only trouble, the direct debit, it's not instant. And I think that's sometimes some of the challenges we have there is that sort of 3-day window where instructions taken from the account and then it comes out, and that's where VRPs can come into play. And we're not using them right now, but we're looking at that down the roadmap for 2026 because that is instant. You can, they make a payment and then it's reflected on their account with us and their account as well. But so that can be some of the challenge, the delay on direct debit sometimes, but that's nothing to Go Cardless. That's just direct debit that's just what direct debit is. But open banking, I think we can probably push more there too.
As you say, I guess that slight delay that you get with direct debit is kind of critical when you're talking about people who are probably very cognizant of what is coming and going out of their account at any one time of the month, right?
Yes, exactly.
With open banking, then you're seeing something there that's kind of exciting because obviously VRPs kind of solve that pain point.
Yes, they do, exactly. And I think it's something that is definitely exciting. We're always wary of anything that's new because we kind of want to see everyone else try it first and then just check there aren't any issues there. I think obviously our payment, because we have 2 payments for every member each month. We have their membership payments in and their loan repayments.
Yeah.
So that's why Go Cardless is such an important partner to us, because that is our revenue coming in and our low payments coming in. So that's 2 vital parts of our business model are relying on direct debit. So for us to shift that to a different payment method is quite a big deal for us. We're quite hesitant of change. It's like turning the Titanic, doing anything different where we are. But we're innovative, but we're quite wary about that. So we are looking into it. We are talking to Go Cardless about it, and I think it's something that can really help our members. Anything to help. Look, it's in their interest too to pay their loans back. It's not us just trying to get our money back. It's like it's in their interest. We want them to get a good credit rating. We want them to go off and be able to find bigger loans and have a mortgage. And we really want to help them build their credit there. So anything that we can do to make paying us back easier and paying off that loan and moving on to the next loan and building that credit rating is good for them too.
Yeah, because I guess something that perhaps many of us take for granted is actually having that credit rating and being able to build it opens so many more doors, doesn't it?
Exactly. Like I just said, we don't, we want our members for as long as they want to be with us, but ultimately this should be the beginning of their credit journey. Yeah. We want to launch them into a world where they can borrow more at better APR because they've got a credit history there. So it's so important. But we have our Go product as well, which we launched a couple of years ago, where we actually offer the ability to just pay us membership fees for sort of up to 6 months. And if you show us a 3-month streak and you can pay us £7 for 3 months, you are much more likely to get a loan with us because we just want that payment history. And that's why going back to earlier what I said about, credit score, actually payment history is a much better indicator rather than have you had a loan before, So I think we're trying to use that a little bit. And we have a huge success rate of people, of our members using Go, showing that they can pay us membership fees for 3 months and then going on to get a loan with us. Yeah. And that's them launching on their credit journey.
Well, that's a really interesting product or model, I
Yeah.
guess. And it obviously works.
Yes, and we're very wary. We're not sort of we're very wary about saying credit builder, because there are products out there who you just pay them sort of a couple of pounds a month forever and it builds it. But actually, if you don't get a loan at the end of it, we refund you all of your money. So,
Right.
you know, if you do go on to get a loan after showing us some good payment history, then it's really beneficial for them. But we don't keep that money if you're unable to. Yeah.
And I'm interested to find out more about your role as Chief Operating Officer. So yeah, what's the role and what's your main focus in that job?
At the moment, it's all about scaling at the moment. So I have sort of the operational teams that report into me, but I go around kicking the tires, making sure everything's working. Thousands of KPIs. We love a KPI. Looking at those every week, making sure there's nothing out of, just questioning everything.
Yeah.
And then obviously making sure we can scale without burning out our team and without sacrificing how good our customer support is. We have amazing Trustpilot reviews. We have an incredible CSAT score, and recently we did an engagement survey with our team. We're at 87%. So we know that our team are happy, they're doing really well, but my job is to protect them. We're 130 employees now. Our culture is fantastic, and a big focus at the moment is making sure we don't lose our culture as we grow too. Everyone's really on board with the mission. Everyone's incredibly passionate about what we're doing, and but at the moment there's a lot of focus on customer operations at the moment because we're scaling. We've had a really fast growth period in the last 6 months, and it's always that sort of, do you take a smart risk and just hire to make sure you can support it, or do you wait till you need it? And at the moment we're in that sort of messy middle balance of like, sort of, what do we need for next year? Doing a lot of forecasting and modelling at the moment to make sure our members get the support they need, whilst using AI and chatbots and all of that to make sure that we scale. We don't want to have to hire one person for every new couple of thousand members. We want to be able to scale that team. So there's a lot of focus at the moment on scale.
So AI is allowing you to do that a bit more cost efficiently then.
Exactly. I think about a year ago, we had around 7,000 members per agent in terms of human agent that we have hired to be on the phones. And now we're at nearly 10,000. And that's all down to using AI, using automation. We want our agents there to be helping our members with the queries that they need to speak to someone on the phone about, not how do I change my address online or all these things. We just want to remove that contact that's just unnecessary. So we've really, really leveraged AI in support and customer support. And now I think collections, there's a real opportunity there too. So that's what we're going to be moving on to look at now.
Yeah, of course. I was going to ask, how does payments fit into your kind of day-to-day role, I suppose? Yeah,
so payments, building the relationship with Go Cardless has been fantastic since I joined. And that was kind of like handed to me when I joined. And it's been great working with the team. They're just fantastic, the team at Go Cardless. And payment solutions, obviously, the movement, there's so much money moving out and moving in, then I really took on about sort of 2 years ago. It was a real case of dispersals, obviously. We needed to make sure we had reliable dispersals of our loans. So money going out, money coming in, is constantly moving. So payments are a huge part of that. And making sure next year we really want to look at, there's been so much development this year on payments, how you can make payments, like you mentioned, VRPs.
Of course.
So really just looking at what is the best option for Creditspring, what is the best option for our members, how can we make it work behind it so seamless that the members don't even know it's happening, and help with collections. So I think we know that there's more that can be done there. We've really focused on growth this year, but I think payment solutions is going to be a big part of next year. I've already prepped our engineering team that it's something we need to allocate some resource for, to make sure that we're staying ahead of the curve, basically.
So it's on their radar.
It's on their radar, yeah, definitely.
And, I mean, we've talked a bit already about the automated direct debit payments that you have with Go Cardless, obviously, to collect those subscription loan repayments. And could you tell me a bit more about how you're using open banking payments alongside that?
Sure. We use the open banking payments. So anyone who's late opens up their account screen, basically, and they have to click a button saying whether they can or they can't pay, and then they're offered to pay by open banking. So we use open banking for our late members. Obviously, if direct debit's on time and that works, and that's brilliant. It's all working behind the scenes. But we use open banking for those that need to make a one-off payment to get back on track, and it's really easy. It's seamless. Most people use open banking now. It is a really easy way to pay instead of getting your card out. So so we're using it for most of our late member journeys.
And do you have an explainer, I guess, to explain what open banking payments are for your members and how they might work? Or?
Yeah, I mean, we use open, and I think there it's more in the journey. Kind of, I don't think we have sort of a cheat sheet of open banking there, but I think when you click on it, it walks you through what you need to do and how it's going to access the account. Yeah.
And how can open banking from a data perspective and also from a payments perspective be kind of powerful, do you think, in the lending space?
Huge. I mean, we've just been talking about credit scores and how archaic they are, and actually how payment history is a much better indicator of whether someone's going to pay our loan back rather than whether they've had a loan before. So, using it, that's why, we are now really pleased to be able to be using open banking for our credit scoring, for the last couple of years as well, because you can go into an account, you can see their payment history. Like I said, subscription payments are a really good lead indicator of credit behavior and, sort of whether they're going to be, they're good people to lend to, because we can see that actually their behavior is better.
You mentioned before about the fact that you're in this scaling and growth phase at Creditspring. So what should we look out for next from you guys?
We've got stuff in the product pipeline, definitely.
Okay.
I think we've been really working hard the last couple of years on polishing our classic model that we've been doing, our sort of four tiers of the subscription lending. We've got Go that we're really trying to scale as well. We do know advertising, I think we really want to push on the growth and we want to spend a little more on our acquisition costs there. So we're going to be doing that. But we do have probably can't really talk about them now, but we do have some ideas on what we want some quite innovative ideas. We were the first for subscription lending. We like being the first at doing things. So there's more to come on that, and real hyper growth like we are. And that's sort of going into 2026 is really exciting, but keeps me awake a little bit at night because I need to make sure the foundations are there and nothing's rattling. And we've got an amazing team. We've got an amazing leadership team. And I think we're in such a good position now to really build on that. And we spent the last couple of years really just tweaking everything, making sure that everything is watertight, making sure that we've got all the right partners in place. So next year is about just pulling on all the growth levers now and making sure we can see that. We have a team in Bangalore that we use for our customer operations, and I think we could leverage them more as well. So a lot of focus there. But yeah, I think our expected credit losses are fantastic. Like they're really low. So we don't think there's loads of room we can do on the collections, but I think there's always room to improve. So I think just making sure we can help our members stay on track, help them get on the best payment plans they need if they're struggling, and always make sure we're looking after our vulnerable members as well. We're really going to build out our welfare team to make sure they've got the right support too as we grow.
What excites you most as you look ahead to the next year or so?
I think there's so much untapped market out there. Like when you read some of the reviews, people are like, how does this model work? We've never heard of this. We had a huge surge of growth a couple of weeks ago when we were a bit worried because we were just like, what's that? And it turns out there was a Facebook page that was just all about 15,000 people just talking about it, saying, has anyone heard of Creditspring? Do you know it's a fixed fee, but it's a loan? And people are amazed by it and they can't believe it can actually be a business model that works. So we want to spend a bit more on advertising. We want to get our name out there more. So I'm excited by the growth, but I'm always nervous because, I just want to make sure our members get the right support. So we've got a fantastic team really pushing for growth, and my job is to just drive the car, keep it on the road, and make sure everyone's safe. Yep.
Well, thank you so much, Hannah. We're really looking forward to hearing more out of Creditspring then in the next year or so.
Thank you.
So we're going to play a version of a Bruce Forsyth classic, actually.
Brucey classic.
Higher or lower.
Okay.
So you know how this works. I will give you a stat and then you have to say whether the next one is higher or lower than that one.
Okay.
Let's start off with the value of RTP payments in the US versus HMRC open banking payments. So BNY Mellon recently processed the largest instant payment in US history for $10 million following the transaction limit increase. Is that higher or lower than the combined value of HMRC tax payments made using open banking in the first weeks of January 2024?
Higher. The RTP was higher, I think.
Why do you think that?
It's just, I don't know. I don't know why I had to think it's higher. I think it's
I'll put you out with three.
Okay.
It's actually lower. So over 1 million payments were made using open banking with a combined value of £3.5 billion.
Okay. Wow.
Yeah. So it probably confounds quite a few people's expectations there. My next one is checks versus buy now, pay later. 31% of B2B payments are still collected via check. Is that higher or lower than the percentage of payments made using BNPL in the UK in 2023?
Lower. People still using checks. That's amazing. So B2B checks. Okay. But I'd say, BNPL must be higher. So checks must be lower.
Okay, yeah, it is surprising that people are even using checks. I
Yeah.
have to agree with that. So it's higher. Yeah, the percentage of payments made using BNPL in the UK was 14%. And I guess for you, you probably have quite strong views on BNPL and its uses, right?
Yeah, I think when you can buy a pizza now using BNPL, it just seems a little bit, we're offering credit a little bit too easily. And is it the most appropriate use cases for it, really? So, yeah, there are a few concerns around that for sure.
Yeah. Well, anyway, thank you for playing higher or lower.
You're welcome.
Okay, so finally, Hannah, we're coming to the section on the podcast where I ask you for your most controversial take on payments or the payments industry, and then I say whether I agree or not. So what's your hot take?
Okay, so my hot take is that payment companies are sitting on the best predictive credit data in the entire financial system, basically, and it's not really being used that well. And I think there's a real opportunity there for, you can see that we've been talking about how subscription payments and membership payments are a really good indicator of financial stability and ability to pay loans back. And obviously, companies like Go Cardless have a huge mountain of data around that that's not really being used. And it's a real opportunity to try and close that financial exclusion gap. So yeah, that's my hot take. I think, why aren't we using that data more?
Yeah, it's a really good point, actually, because it's real-time data. It actually gives a very comprehensive picture, doesn't it, of
it does
expenditure
on top of
and
that
income.
credit scoring, which is all about historical, just sort of credit history, but actually payment history. We're seeing when we're using our open banking scorecard, we're seeing that it's a fantastic indicator. Payment history is a great indicator of their performance.
Yeah, and we say it with rental payments all the time.
Exactly.
Right? So what's the solution there?
Data sharing, I guess, at some level. I don't have a solution right now, but there's a gap there, and I think the fintech industry isn't joining the dots quite yet. So we just need to, use that data better. It always comes down to data, doesn't it?
Yeah,
so
absolutely.
Data sharing,
Yeah, well, I think that's a really good view and a great note to end on. Thank you so much, Hannah, for coming onto the podcast, for sharing your views, and for telling us all about Creditspring.
Thank you for having me. It's been great.
Thanks again to Hannah for coming onto the podcast. Great to hear what Creditspring is up to, of course. And you can catch up with all new episodes of Settling Up with Go Cardless on YouTube and on Spotify. Until next time, I hope that settles things.